What's up, guys? It's Cash Flow Cart. Today, we're going old school. We're doing a Reddit reaction type video. We haven't done one of these in a while. We've been more focused on, my own portfolio. We've gone through a few individual stocks. And I have done a couple more SCHD videos than I intended. But, SCHD is like so commonly talked about in this community that I get inspired about it a lot. So let's get into this, guys. We're gonna start off. I saw this. I thought this was a good opening. What percentage of your portfolio do you sell per year? 0%, guys. As dividend investors, this is our goal. Our goal is to generate a growing stream of passive income that allows us to keep our nest egg, our original capital, intact, and we don't have to worry about selling off shares at any point to provide extra income, guys. Does that make sense? That's why I love dividend investing, because I want to build, a great size nest egg that also pays me a lot of passive income every single year. And with dividend growth investing, we will see that number step up year after year, guys. Let's get into the meat and potatoes of this video. All right, so I just kind of touched on that. Why do you invest in dividend stocks? I see this on, the Dividend Gang subreddit. And then this guy says, in 2009, I graduated from university, started making $120,000 per year salary. I will say, for a 2009 graduate, that is a very impressive salary. If you guys know, I just recently graduated from IU. I'm still finishing up like 2 classes this summer, but I'm pretty much graduated. And I will say $120,000 is quite the offer, especially in 2009. So he says, life is good. And then my pregnant at the time wife asked for a separation, which resulted in a 4-year-long divorce process. Okay. I mean, I didn't read all the way through this, but it seems like this guy was going through kind of a dark time in his life. Hopefully he is doing better right now. But why do I invest in dividend stocks? I just kind of touched on it, but it is so motivating to me to see that growing stream of passive income that I can work on every single day. Every single paycheck, I try to dedicate, some proportion of it into my account. And I've seen, year over year, my dividend income step up, and I'm starting to see this compounding effect in play, guys. I'm 22 years old. I'm actually 23. Oh my gosh. This is my first video I filmed as a 23-year-old. I'm getting up there, I guess. But I'm 23 years old right now. I started my main dividend growth account when I was 16, and I definitely learned a lot of lessons, experimented with a lot of different things. But why I kind of stuck with dividend investing is because it's a great way to understand, and to see value in stocks. I feel that is a very beginner-friendly way to become profitable in the stock market. But with that being said, there is so much room for improvement. Okay, guys? The biggest room is room for improvement. So whether you're first starting out or you're 10 years into this game, I feel you can always improve. You can always see, okay, I like this method of valuation better. These types of dividend plays resonate with me better. But that's why I love dividend investing. And, the passive income every month is, it's very encouraging. It keeps me focused. One other thing, if you are trying to build wealth and you are a beginner in this game, I do think dividend investing is a great way to kind of understand a lot of concepts of finance and to start to get your wheels turning on where you can see value in different areas, and you can see value in, different types of investments. So I do think dividend investing is a great place to start kind of your wealth building journey, but I'm definitely going to continue dividend investing for the rest of my life. And hopefully that is, a long while, and I will stick with you guys on YouTube every Monday at 6 p.m. Let's keep going. This next comment we'll be reacting to, this guy said SCHD plus 5 stocks max. Hey guys, advise individual stocks to SCHD plus 5 max. So the way I interpret it is, this guy has a portfolio, he's got SCHD in it, and he wants to add, 5 more individual stocks that he could see as, spicing up that dividend yield, adding some capital appreciation, things like that, guys. And you guys know how I feel about SCHD, unless you are kind of in retirement. My reaction to this one would be to skip the SCHD and really focus on, adding one stock at a time, 1 or 2 stocks, and identifying when these stocks are undervalued and really trying to seek that outperformance of SCHD. Because if you find 5, awesome stocks that you see value in as an investor, that you have capital to build out meaningful positions in, why are you going to waste time and capital on SCHD? And I understand, this is kind of a matter of your own personal risk tolerance. Maybe you are in retirement and you do want SCHD in your portfolio. But, like we talked about last week, guys, SCHD, we need to stop putting it on this pedestal. Stop kind of thinking of it as some holy grail to the dividend investing community. SCHD is a basket of 103 dividend paying stocks, and it essentially tracks the Dow Jones US Dividend 100 Index as closely as possible, and it is mechanically operated, okay? For me, I do like to have discretion over my money, and I do like to identify stocks that resonate with me, that I see value in. And again, I'll say it, but I can't get behind, just putting money in a basket of 103 stocks, okay? Because for any investor, it's never going to be possible to see value in 103 stocks at one time. It doesn't make sense to me. Right now, I don't have any ETFs in my portfolio, guys. If you actually look over here on the side of the screen, I have 7 holdings currently. As a 23-year-old, I'm comfortable with that level of diversification. Okay, guys, as I grow and mature and get older and closer to retirement, I will hold more than 7 stocks. Yes, I will add positions throughout the years, but if I'm going to be picking individual dividend stocks and building a dividend portfolio, I'm going to skip SCHD. Okay, that's kind of my take on this, but let's keep going. Okay, so I don't know if you guys use Reddit at all, but I probably spend too much time on Reddit personally. I do see a lot of people just showing their portfolio to other investors, to other people that are kind of in a similar game. However, I do want to caution you against that. I do want to caution you from falling into kind of this groupthink mindset, guys. Doing due diligence is not it's not necessarily just getting other people's opinions. A lot of times it's finding out what works well for you, and whether you're adding 1 stock at a time to your portfolio or 2 stocks at a time to your portfolio, if these are good quality stocks with wide moats, you're on the right track. Does that make sense? And I think a lot of people, especially beginners, fall into this trap of immediately creating some picture-perfect portfolio, and it oftentimes leads them to kind of, miss out on a lot of great opportunities to learn and build their portfolio block by block and to, truly be proud of it. Guys, this is a marathon. This is not a sprint. So don't get so caught up in, how your portfolio may look to someone else with a completely different risk tolerance than you guys. Again, we all are part of this community, but with that being said, we have different risk tolerances and we all have different goals and aspirations in life, guys. Averaging up, this guy said, I will officially be averaging up in all my positions as I continue to weekly dollar cost average. Kind of bummed. LOL. Okay. I like a couple things about this comment and I dislike a couple things. It seems this guy is kind of very systematic and very focused on staying committed to this game. I really like that, okay? I want to remind you guys this is a long-term game. It takes a lot of time, and it takes a lot of commitment to building out positions. However, by the way he phrases this, it kind of seems that he or she is more focused on kind of just, okay, these are my positions, regardless of what valuation they're at. I'm going to just average up in all of them. I'm going to put an equal amount of capital into all of them, weekly, he says. For me, that's a little different than kind of my school of thinking. The way I go about things is typically trying to get my money into my best one or two positions. By best, I mean, most undervalued, best historical dividend yield. Usually I use kind of a 5-year track record for determining that. But again, there's nothing wrong with averaging up. I will show kind of my own personal example really fast, guys. We talk about Pfizer all the time on this channel, but, why not, I guess. So we'll go to the 1 year, 1 day chart. I think that will provide kind of the best context for us, guys. I have 217 shares of Pfizer. My average price is $33, almost $34, and that puts me right now with Pfizer's current stock price of $28.66. I am down $1,148, guys. Again, I'm not really tripping about that though, just because of kind of my long-term approach to this game. So I'm not going to do my whole song and dance about Pfizer that I usually do. You guys are probably tired of hearing about it. But so here you can see, like I said, this is a 1 year, 1 day chart of Pfizer. That means this chart goes back, 1 full year. And each of these candlesticks represents 1 trading day. So Monday through Friday, with the exception of holidays when the market's closed, like we just recently had Memorial Day. You can see I was originally averaging down in Pfizer, okay? Once I saw Pfizer break down below this $40 mark, I kind of, I started to get very interested in it, and I started to get very interested in its current dividend yield, which, looked much more attractive than kind of its 5-year record. Does that make sense? I start averaging down and building out this position. Guys, you can see here from all my buys, week after week, I was very comfortable averaging down, okay? And I will say that's going to take time and it's going to take experience, but, after you've done this for a little while, you're not going to have any problem averaging down in this game. Then what do we see happen in Pfizer? A few months ago, it kind of flattens out. It kind of looks like it's creating a bottom, and I'm still averaging through it, okay? Like I said, I'm not just dollar cost averaging into all of my positions at random. No, that's not what I'm doing. I started this position in Pfizer. I'm interested in building it out, so that's where my focus is, okay? Does that make sense? That's where my new capital is going, and as well as that's where my reinvested dividends are going, guys. And now, as we've seen Pfizer bottom through here, it does look like it is kind of beginning a reversal. And as long as Pfizer stays attractive to me, kind of under this $40 mark, I'll continue to average up and build out that position. And what that's going to do for me is lock in, an attractive starting yield. And it's also going to lock in, an attractive cost basis that I can hopefully build on, you know, in terms of capital gains in the future. Okay, I hope that makes sense, guys. I didn't want to make this a Pfizer video. I know you guys are probably tired of hearing about Pfizer on this channel, but we will keep going. Good, stable growth dividend stocks that aren't greater than $50, guys. So he said, I'm looking to start, he or she said, I'm looking to start investing into dividend and growth stocks, but most are abhorrently, I'm going to be 100% honest, guys. I don't know really how to say that word. Abhorrently expensive to just buy one. Thanks, people. And I think this is a pretty valid question, but, you know, I go to the replies and a lot of people are like jumping on this guy like, oh, just buy fractional shares, you know, research what broker you can buy fractional shares at. I do want to address this, okay? Because for me individually, building out my portfolio, I've never really bought fractional shares, okay? In my case, I was using TD Ameritrade, and when I started, now it's a Schwab account technically. But I will say I was unable to do fractional shares myself, and let's talk about it. If you are kind of in that same case where you're wanting to buy kind of, you know, even number of shares, let's talk about this. My approach to this would be either to save up an amount of cash, you know, $2,000, $3,000, $4,000. I remember when I first started this portfolio, I saved up like $3,500. I'll have to go back and look at the account history, but I think at this point the portfolio was like Apple. So I save up $3,500, right? And I think I started the portfolio with like Apple, Johnson & Johnson, and Tesla. You know, I don't hold any non-dividend payers. Fortunately, I was able to lock in a lot of capital gains on Tesla, but that's another story for another day. My point I'm trying to make here is if you're starting an account, I would probably save up enough cash to where, you know, you can focus more on the fundamentals of a company, the free cash flow growth, the free cash flow payout to dividends. And if you save up enough cash, you won't be kind of too focused on the price per share of individual stocks. When it comes to kind of continuing to build your portfolio, like for example, if I get a paycheck, we'll take realty income, for example. I have 215 shares of realty income. That's a monthly payer. It pays me about $56 on the 15th of every month. Let's say I get $56 in the portfolio. I'm not going to be able to buy a share of Apple to reinvest. So, you know, in that situation, you can just leave the cash alone. Or if you are interested in just spending the cash right away, I guess that would be a case where, you know, you might look through stocks you already have and focus a little more on the price per share. But again, this whole comment kind of got me on a tangent. So let's not focus too much on that, guys. I think we have a few more to get through. I'm thinking on opening a position in J&J. Any thoughts? Okay, so like the title suggests, I was thinking of opening a position in J&J. It looks to be a bit undervalued at the moment. Any thoughts on this would be appreciated. I didn't want to react to this comment so much to kind of go through the J&J fundamentals. I did want to react to this comment to focus right here. It looks to be a bit undervalued, guys. And real briefly, you know, we've got other videos that go a little more in-depth into this, but I want to show you guys a very beginner-friendly and easy way to understand kind of, you know, if a stock is undervalued. And I will show you kind of what I have done in the past, just kind of in the screening process, guys. So I go to Seeking Alpha, I type in the ticker, and I'm going to navigate over here to the valuation tab, guys. Again, There's more due diligence you should do, but if you've identified an attractive dividend stock, it's very essential to focus on the valuation and make sure you can kind of lock in, a good starting yield as well as a good cost basis on these. So I go to the valuation tab, and there's there's probably 100 different ways people value stocks. For me, as a dividend investor, I think the most essential is going to be right here, guys, the forward price to cash flow valuation metric. Okay, so it's a stock valuation indicator or multiple that measures the values of a stock's price relative to its operating cash flow per share estimate. And that's where we get kind of the difference here between the TTM, trailing 12 months, is going to use actual operating cash flow per share, versus the forward FWB is going to use, the 1 year estimates. Okay, so price over cash flow. And I take this number, and rather than just kind of looking at this number in isolation or comparing it to peers, what I like to do to determine value is compare this number. Okay, so for Johnson & Johnson, it's 13.23. Again, I haven't looked into Johnson & Johnson recently, and you can see the sector median is 15.27, guys. I'm not going to get too caught up with the sector median. What I like to focus on is right here, J&J 5-year average. Okay, and the reason why I avoid kind of this sector median is because we've talked about it before on this channel. Every stock, we're going to need to take kind of a different lens to, okay? Every stock is going to receive, I guess, different, a different quality valuation, okay? Does that make sense? A different valuation multiple, if you will. Okay, so what I'm going to do is I'm going to compare the current price to free cash flow. Again, that's on a forward basis. And I'm going to look at, okay, what has that multiple been historically on a 5-year basis? And I really like that Seeking Alpha makes this so easy to use. They even show you right here. Okay, so 13.23 compared to 16.39. Just using this metric, it could show that Johnson & Johnson is 19.27% undervalued right now. Does that make sense? And again, we'll have more videos. We'll talk a lot more in depth about different fundamental tricks or tips I use. But I think this price to free cash flow is a great way to kind of identify undervaluation in quality stocks, especially mature stocks. Okay, so I wanted to go through that example really fast. And to answer your question, I'm not going to say, if I personally am adding Johnson & Johnson, I am just going to say, this is what I would look at to kind of assess the valuation. This would be my step one, is this metric right here, guys. And with all that being said, guys, thank you for joining the video today. I hope you guys are all having a great summer. I personally am. I said I am finishing up 2 classes. Well, I mean, technically 3, but one of them is like stress management. And it's not even like a synchronous meeting type of class. So I have 2 synchronous classes, 1 other class I'm finishing up, and then I will officially be graduated. I'm living in Bloomington this summer. It's really nice. Kind of, I guess, living in a college town in the summer is kind of refreshing because you kind of get away from all the craziness of the school year, especially kind of a huge school like IU. It's a little refreshing. There's not near as many people at the gym if I want to go work out. There's not near as many people at the pool. I will say the only kind of downside is anytime you're in or around a college town, it's much harder to make money in the summer because there's just not near as many people in the area. So, a lot of jobs cut back their hours. And if you're kind of working for tips are going to be a lot slower. That's my only complaint. Other than that, I've really loved living here this summer. I hope you guys are having an awesome summer as well. I got this little guy, Mia. This is my dog. If you're new to this channel, I don't think you've been in a video recently, Mimi, but this is my dog. She's a Boston Terrier. She's almost 3 years old, and she... Do you want to tell them to subscribe to the channel? Okay, subscribe to the channel, guys. I will catch you next Monday at 6 p.m. Everyone take care, and let's build wealth.